Good morning. Today on the workshop, we are going to discuss and talk about and break down and relive and cry over the worst trade we've ever made. Let's check this out after the bell. Yeah. Mm-hmm. You love it. You know it. You just can't get over it.
I certainly can't get over it.
Oh my God. All right. Well, guess what? We're not officially into summer until like the 21st. Is that the right date? 21st or 22nd? I forget always. The equinox. But it feels like summer. I don't know where you guys are, but it's been a hot like a mother where I am. Very moist.
Oh yeah, we got a scorcher out here.
Yeah. You're okay, Jason?
Yeah, it's been okay. The past couple of days, it's been very humid and pretty hot. But like last week, it was gorgeous every day. Like
yeah,
72 and sunny.
Yeah, no, it's been nice. We've been getting a lot of rain lately, so which we need because new plants.
I thought you were going to be upset because the Bears are in Indiana now.
No, hey, listen, if we can't figure that out, we don't deserve the Bears, so so be it. Okay, so today, the worst trade we've ever made. Now let me sort of give a premise first of all. Okay, at least from the market maker side, it's hard to make a bad trade on the market maker side because your markets are up there, and assuming you agree with the bid and the ask and you respond to it, it's probably not a bad trade, right? It's only a bad trade when you reach for something potentially or do something like that. I think from my perspective, Mark, you might have a different view on this, but from my perspective as a market maker, I've had bad positions, right? And I've done things with my positioning that have been really stupid, I guess, really bad. So I'll come at it from that. Now, on the retail side, you have a proactive situation where you're looking at a screen and you say, I'm going to do this. And you go out and do it. And that I could see would be a bad trade. So maybe, Jason, you might have a little bit more flavor and color relative to a true bad trade. At least I'm going to have a bad position, a bad decision on putting more poop on top of the dung pile is what I did. So we'll get to that in a second. Anyone else?
I'll actually add a caveat to the market maker angle because like what we call bad trades, we're generally, yes, I agree with the whole idea that like if you're trading on the bid ask, that's generally providing liquidity. That's part of the business. You don't think about it like on a per trade basis. You think about it as like risk accumulation.
Right.
We would identify bad trades as generally being a function of some kind of like system error, like a scenario where your computer's trying to stream quotes at a bunch of things. All of a sudden it bricks because it gets too much market data and you can't get your hedge. So you buy a call for $1.20 and all of a sudden you need to sell stock, but stock's, $2 lower. So bad trades were scenarios where you had some kind of bug, you had some kind of computer lockup moment. There were quotes in flight that didn't make it to the exchange, like whatever that is, more on like the technical side of things, we'd call bad trades.
Yeah, that's fair. I think I agree with that too, by the way. And that just brings to mind another bad series of trades. I'm going to throw this one in too, because that just reminded me of another one that probably caused me to get out of the market maker business or the DPM business because of this bad trade, So we'll talk about that too. All right, Jason, what about your thoughts on, not specifically the trade, but just, the bad trade, the worst trade, I should say.
I mean, when I talk to people about them, I say consider it tuition to the school of hard knocks.
Mm-hmm.
If you don't learn from it, then even if you learn that you're not cut out for this, if you don't learn from it, don't let it go to waste. But overall, though, basically it's psychologically handling your bad trades as opposed to forgiving yourself is more critical. I've never been on the market maker side. It's not about systems. It's more about psychology and planning, and also, you know, getting hard on yourself when you lose.
Yeah. Right. I would think for you and on the retail side, some of the bad trades kind of are sourced from not following the plan, or being undisciplined, or being emotional, or, you know, doubling up, that sort of stuff. Is that somewhat accurate, you know, in the sliver?
Yeah.
Okay. Okay. Who wants to start? Anyone want to start? I'm gonna have two, I think, if we have time.
I have 5.
Oh my God. Okay. We'll do a couple, and then we'll go to Mark, and I'll go, and because Mark's and mine are going to be somewhat similar, I think.
All right. Yeah. No, mine's probably going to be a little bit more relatable this time.
Okay.
And I won't count like my first option trade, right? That was a bad trade, but it wasn't, you know, completely devastating or whatever. Okay. So when I first got into options, I did talk, you know, I got very much into like the variance risk premium, like the income harvesting kind of stuff.
Mm-hmm.
It worked most of the time, but then I thought, you know, most of that income harvesting happens in like the last little bits of option expiration. So I had a trade plan where in the last 30 minutes of the day, I would put on like a condor or a fly based on where the SPX was at the time. And back then it was like in the 2000 area. So it wasn't like, you know, putting on a 10-point condor is actually, you know, like 2 or 3% of the market or whatever. But anyway, so in the last 30 minutes, I put them on, and for a little while, it worked really well. Right.
Mm-hmm.
And then I said, well, this is working really well. And this is also by the time Mondays through Thursday options didn't exist then either. So this is a while ago. And and I didn't martingale, but I would, you know, I would do like the okay, I put in way too much risk into this once it started working well. I put in like a quarter of my portfolio, or like 20% of my portfolio. And then there was just this stretch like 3 or 4 in a row where I lost 80% of my portfolio.
Oh my God.
Every Friday. And it was just, and you know, I found at the time I thought, oh, implied volatility is up. I'm getting this for cheap. And it was up for a reason. Right. And it would spike in those last 5 minutes. And every time I see a spike nowadays in those last 5 minutes, I get a little like PTSD.
Mm-hmm.
But to that 1 week over, like, I think it was like Thanksgiving or something like that in 2013. So yeah, even before Captain Condor came out and did it for a 1 day time period, I was doing it in 30-minute and 20-minute time periods.
Love
and yeah.
How did you cure your addiction?
Oh, the losses helped. The losses cured my addiction. I said, oh, I gotta stop this. Like, this maybe worked for a while, but I do not have the heart for this.
Yeah. Okay. That's a good one.
Yeah, it stinks when you go on the beach, and you know, it's like you know, my aunt had a beach house, and we went there for like Thanksgiving or something, or for, you know, like a pre-Christmas kind of thing. Right. And I'm on the beach, and I'm like sad, and I'm like, how can I be sad at the beach? I can't do this.
Oh, God.
So that was probably my number one worst trade plan.
All right. Mark, how about you? Now, I know you're going to come more from a market maker angle, as will I, but we'll try to hone it in here.
Sure. Well, I mean, I was just thinking as Jason was talking about the whole like sizing up thing, and it's amazing how much of a commonality that is in all bad trades, is that there's almost always a sizing problem in bad trades. And, you know, that just, you know, underlines how important sizing is with any trade.
Sure.
But no, I actually really liked your point earlier about how, you know, thinking about it from a market maker's perspective, it's not necessarily one trade so much as a series of positions that you accumulate and don't trade out of it, or actively trade into it intentionally. And the learning experience for me came in Joseph A. Banks. So the like 3 suits for $99 kind of store. Yep. Obviously that business model wasn't going so well. So there was a lot of short interest in the stock. And I was relatively new, it was in my first couple months. And while like we sort of covered hard to borrows in, training class. It was like a 2-day session at the end of everything. And, we never really had that much experience with them.
Sure.
And so as this is happening, I'm not even explicitly like selling reversals. Like I'm not getting directly short stock, but it kind of creeps up on you. You buy a call here, you sell a put there, and all of a sudden, like your stock position becomes somewhat material.
Mm-hmm.
And the way that they handled short stock fails was slightly different back then. So now there's like a 4-day window. It's much more kind of consolidated and transparent, really.
Mm-hmm.
But in this previous world that kind of came after the Great Financial Crisis, I believe they implemented the reg show system.
Mm-hmm.
And you had 13 days to cover stock that was failing. And you meant the entire group. So there's definitely like some gamesmanship across like, different cities that would, the Chicago guy trading Joseph A. Banks would be on a different clock. And, everyone would kind of have their positions. And sometimes stocks would fall off, right? Sometimes they would no longer become hard to borrow because magically Merrill discovered a bunch of stocks somewhere.
Mm-hmm.
And that was always very opaque. So everyone kind of tried to play the game of waiting it out. Maybe this will fall off. Maybe this will fall off. I tried to play that game, and come day 10 or 11, I forget what it was, but that's when risk really starts to clamp down. And all of a sudden you're just buying conversions back for, dollars more than you were collecting on them. And it was one of those things where you really notice the dynamic of the system, and you learn pretty quickly what that's like. But then, to pay attention about how you're accumulating that position, because it wasn't like I sold a bunch of reversals, like I said, it just, slowly seeps in there, and you go, all of a sudden, I'm short a lot of stock that I have to buy back.
So how did that play out?
I want to say I was short on the order of like 40,000 shares, and all of a sudden you're paying, $1.50 for those for those conversions. And, at the time when your book is like tiny and you only had like 20 stocks at the beginning, it was like, this is my month out the window. What am I doing here?
Yeah. Right.
Well, so Joseph A. Banks will forever live in infamy in my book.
Yeah. Yeah. Well, I got one too, but it's funny. Mine's the similar story, and I can't remember the name of the stock, so therefore it's not living in infamy. I just remember the situation, right? So, couple points on Mark's comments. Hard to borrow. What does that mean? We're talking to probably more of a retail audience, and they probably don't do a lot of that stuff. So, in a few words, can you tell the folks what that actually means when you sell stock, how it's borrowed, and all that kind of good stuff?
Sure. So that's exactly it. That there is demand for short stock, and some of that comes from short sellers that need to go and borrow shares, sell them in the open market, hope the stock goes down, they can buy it back lower. So that's one source of demand for short stock. But another major source of demand for short stock is going to be your market makers that are simply hedging normal activity. And to the extent that you broadly want to say the buy side is buying puts and selling calls, that means market makers are doing the opposite, and they're shorting stock, which makes sense because if you're doing options as sort of protective strategies, you are going to want to protect against the downside. The market maker needs to hedge against that when he sells you that risk. So options market makers are big sellers of stock generally. And to borrow that stock, your clearing company will go out, and there's a whole bunch of lenders of stock. So people that are, long only, the Northern Trusts of the world, and big asset managers will sometimes loan their stock. But not everyone always wants to loan their stock. There are obviously opinions about short sellers. People don't want to sell that, but the borrow market works like any other market there. So if it is hard to borrow that stock, that means that you can't find shares to sell short. And as a market maker, you got the ability to sell immediately. You could go into your terminal and hit sell, and it would clear, it would trade, you'd have a price and P&L on that. But someone had to find that stock for you. And that's sort of what that window was there. And, that's part of the clearing company's job, is to source that stock and charge you a markup for getting it. But if they couldn't find it, you had to buy that stock back because it was on the fails list, the fail to deliver. And so, that market gets very tight sometimes.
Yeah, and then when you have to buy back that stock, remember for a market maker, what happens is that's a short delta for your inventory. And when you have to buy that back, you lose that short delta. Now all of a sudden you become long deltas. And depending on how big that position is, it can be a lot of deltas, right? So you are scrambling to find a substitute short when you get bought in. And you know, the likelihood is you're probably trying to sell it again, right? And make the clock start ticking again.
Right, because you want that rate to go down, back down again, because you've been, but yeah, and that's why I say that you have to buy the conversions, right? You can't just go outward and buy, you know, 40,000 shares of stock, because then you're long 40,000 deltas. You're short a bunch of puts and long calls that were supposedly hedged here. So you have to buy that put, sell that call, and sell stock against that.
Right. Okay.
And buy stock against that. Sorry.
Yeah. Okay. Good. That's a good one.
So if there's heavy option traffic on a hard to borrow stock, that's like, you know, a lot of people buying puts, that's a squeeze opportunity, possibly.
Absolutely. And that's where you see the pricing adjust, right? The interest rate in the model gets increasingly negative to the extent that there's one-sided stock directional trading.
Right.
Yeah.
Right.
Interesting. Okay.
All right. So let me do a similar one for me. And this was a freaking just a bonehead deal. Okay. It was like one of those trades that it's too good to be true, right? And you know that when it's too good to be true, it probably is. Okay. So what I'm going to do is I'm going to ask Luis to take us to the whiteboard. Oh my God. Here we go. You ready for this? Look at this scratch. Okay. We're going to talk combos. That's this guy up here. And I'm going to say the dividend was 10 cents. Okay. And I'll give an example. Now, similar to Mark, what was given to us, again, we're DPMs in this world. We were doing this trade. So we were doing combos. We were buying call, selling put, same strike. It was a 50 strike, and I'm making the 50 up. I don't remember exactly what it was, but for illustrative purposes, that's what it was. And the stock was trading 60. Again, don't remember, but let's call it that, right? So someone was coming in and actually selling us this combo, meaning they would sell us the call, so we would buy it, and they were buying the put from us, and we would sell it, okay? So we're selling put, and we're buying, I'll put long for call, buying the call, right? We're long synthetic stock is what that is. So you're naturally long the stock with that position. Same strike, same expiration, same number of contracts, right? They were doing this as a package. Now, the way this works for the people listening is that when you buy a call, in this case, I put $10 and I sold the put for 2, the net there is 8. Long 10, short 2, that becomes 8 net. Add that to the strike to figure out what synthetically that stock price is. So if you get 8 plus 50, you are buying stock for $58. Does that all make sense, everybody? Right? Now, I could hedge this position one by one by selling stock in the open market at 60. How is that possible? Buy 58, sell 60, I lock in $2. I do have to pay a dividend of 10 cents. So $2 minus the 10 is 1.90. That's a lot of edge. Would you agree, Mark, in the market maker world, $1.90 per contract?
Oh yeah.
Okay. That's a lot of edge. Guess what? That trade continued, and it not only it went from $8, then it went to $7, then it went to $6. Now I'm getting $4 of edge in my mind. And I'm continuing to do this trade until the light goes on in my dumb head, right? What's going on here? Okay, now I'll tell you retail folks that you're probably not going to ever experience this. A, the clearing firm won't let you, and B, you're not going to be dumb enough to do what I did. So I've got all this edge. It looks great in the sheets, but it's never revaluing itself. So light goes up. I'm like, oh my God, special dividend, right? I'm like, shit, the special dividend will kill you. Because why? That draws away from this whole creature. Remember, I took 10 cents away from my $2 to get $1.90. Well, what if the dividend's $1? Okay, now I got to take $1 from my $2. Now it's only $1 of edge. What if it's $2? Whew, you see where I'm going here, right? And in those days, they would issue special dividends one time, right? And then that one time you'd have to pay it, and it's over and it's gone. And there was a rule at OCC in the clearing firms, I think it's more OCC, that if it was over 10% of the stock, I think it was back then the strikes would adjust and the dividend would have no material impact on the combos. Okay. This one just made it under the 10%. Okay. And again, my numbers aren't going to match up, but it made it just under the 10%. The strikes did not adjust. And I had this massive position on 1,000 times for what I thought was dollars of edge that became negative edge on the opposite side. Right. So what do I have to do to make up for this bad series of trades? I've got to start figuring out a way to get long stock. So I'm starting to pay up for conversions by buying puts and selling calls at what looks like terrible prices, anything less than I could get for this one, which wasn't easy because everyone knew the story. And all of a sudden, the news comes out, it's a disaster. Everything revalues. And I'm like, and I got killed, right? End of it. It's over. So what did it work out to be? What do you think, Mark? You would know better probably. I mean, how many times before I hit the stupid button did I do this, do you think? And, they're doing 10s and 20s. And, at some point I'm going to say, uncle, and I'm like, wait, this is too good to be true. I'm done.
Yeah, see, volume's different, right? That's why you were getting $1.90 on this. So
I'm the DPM.
You got up to like 500 or 1,000.
Okay, good guess. I got to 1,000.
Yeah.
Got to 1,000. So I had 1,000 long combos, short 100,000 shares of stock. Is that right? Is that more than that? 100,000 shares of stock, right? In this position, I think I'm just like, oh, this is great. $2. This is awesome. Well, the news came out. This stuff all did its thing. My puts went higher. My calls went lower. And I'm long the call. That went lower. I'm short the put. That went higher. Had to ultimately pay the dividend, obviously. And that came out to the tune of, final guess, $850,000 loss. Cha-ching! Woo!
That's not a month, that's a year.
That's the dumbest trade ever. Now, again, we're DPMs and, we go over this risk every day, and all of us are looking at this going, we know it's a special dividend. I know it's special dividend. I know this is it. And now once you figure that out, you're like, run for the hills. Because this didn't have any activity. It had a little activity. It was a good stock, had a lot of edge in it. We're making money hand over fist. And man, this came out. God dang. And guess when they did it, Mark? In a leap. It wasn't in like next week. It was like way outdated in time. So, they made sure they covered all the bases of when this dividend could occur.
Love that.
What a dope.
So the lesson there is know everything about the stock you're trading.
Well, yeah, look, it's also like, oops, I lost. Where'd you go, Jason? There you go. I lost. That's true. And, this was later in the game too. And I'd say, we should have known better. We knew this stuff. We were really good at banking plays and dividends and boxes and all that kind of stuff. So we knew banking really well. And for us to miss this one, it was like it never had a dividend. The dividend crept up in our minds, and we're like, and then all of a sudden, it really, not only did it creep up, it snuck up on us. It took a baseball bat and a sledgehammer and knocked us in the face. So, but yeah, it's hilarious in hindsight. But
well, yeah, I mean, yeah, like I'm one of those types that loves to go on YouTube and watch the people lose in real time.
Yeah.
So, but I laugh because if I was on YouTube doing all my losses, especially earlier in the career, somebody else would be laughing at me. So
yeah. Well, and again, for the folks listening, guys and gals, this is something that's not going to happen to you in the retail world. You're not going to do this. Okay. First of all, it's almost impossible for this to happen to you. The reason it can happen to us, Mark and me in the old days, is because, especially for me, I was a DPM. We were the only market at times. So there was no other person to help us out. So we had to make a market. We kept moving that combo better and better for us. And I'm like, God, they're still buying it. Holy shit. And we're kind of forced into a bad position, but we should have really moved it when we figured it out, which we did, but it was $850,000 too late. So.
Yeah. I don't know if it's knowing everything about the stock so much as position management, because you can get into the weeds about like what could happen. Are they buying puts because they're hedging? Are they buying puts because it's a dividend? Like all those different scenarios kind of just muddle the risk that you're short, 100,000 shares in this. Like that's going to be a problem if something happens, regardless of what that problem is.
Right.
It's like keeping an eye on positions that slowly accumulate in one direction and adjusting to that.
Yeah.
You can sell high rates, but you also got to buy high rates too.
Yeah, exactly. And that's what we did. And once we figured it out, we started just overpaying for things and trying to get something, which, looked terrible, at the time, but hey, it actually mitigated some of the loss, believe it or not. I mean, we still lost that number, and we had mitigation trades on there as well. So think about it. It could have been a lot worse. That can be part of the game in the market maker DPM side, I think. I'm guessing today that probably doesn't happen very much in the market making world even at all. I think
it seems like market makers have a because from what we see, skew curves move a lot quicker than positioning does.
Yep.
I think market makers are a lot more in tune with what's going on in all stocks. Like, it's because, sometimes I look at things, I'm like, that looks really too good to be true. So it's like, sometimes it isn't too good to be true, but do you want me to run through my other bad trades that are probably more relatable than your guys?
Yeah, ours are relatable. And if anyone has a question on that, fire it up in the chat here or the comments. I know it's kind of hard to understand. I went fast. I always go fast, but if you don't understand it, we can explain it a little bit again relative to how that combo works with stock. So that was a reversal that I did. That was the reversal side of it. The opposite is called a conversion. Okay, so if you guys don't understand that, either email me, lex@tradier.com. I'll explain it there, or throw me a comment here and we'll figure it out. Okay, sorry, go Jason.
All right. I had a trade plan going into an OPEX in which I had like a calendar, and then I wasn't expecting the stock to move much, and if the short strike expired, I would either have a long gamma or a short gamma vertical. The market went a little bit away from my calendar, and I decided, we're going. Even though there's a CPI print coming, it's only a couple days between now and then. I could squeeze a couple extra pennies out of this if I make it a short gamma vertical.
Sure.
That print wasn't very good, and I spiked and lost my money. It spiked right past it. It jump risked like 40 points or 50 points way down, made my short gamma vertical a long gamma vertical real fast.
Wow.
So that was a bad trade. That one is probably one of the more recent ones out of all these. It was still several years ago, but okay. Then I had an amazing trade plan. I thought I did all this research on a merger arb, but yet the options were so far off the merger arb price that I was like, how do I lose on this one? And then COVID hit, the merger still happened, but it moved it past my expiry, and I lost money, even though my thesis was right. It was just COVID.
Your timing was wrong.
Yeah.
Right? Okay, that happens. Yeah. I've had that happen to me too, for sure.
Yeah. Yep. Okay, I tried to trade a stock into a stock split to try to get that little penny kind of thing, but I misdid the math, and I ended up basically guaranteeing I lost money.
That's always a good one, misdoing the math.
Yeah. And then I have two more. One was having an alert on my phone, and then trying to, I was driving home at around 3:50. There was some event or something like that. It started spiking one of my legs in my short gamma butterfly, and I tried to trade. I tried to pull over and trade from my phone, misput in the order, and guaranteed I lost money, even though we were closing really close to ending up closing near my short strikes. I still lost money because I put in the trade. I put debit instead of credit or something like that. And then when I was in my income trading phase, I thought I'm going to try to keep my theta maximized by adjusting almost at the end of every day my condor, so that I'm always kind of in the middle of it. Right. And I basically killed myself on all the adjustments and all the commissions and all the little slippage and stuff like that. I just killed myself until the end, where I didn't actually make any money, even though it stayed within the bounds of my condor the whole time. So those are some of the stupidest things
I'm
I've
sure,
ever
yeah.
done.
Look at it. Everyone does that. I'm positive that some of the viewers here have done that as well. But
Yeah.
you said something earlier about the tuition or something like that.
Tuition to the School of Hard Knocks.
Yeah. So I learning this skill, this option skill over my career. I made a lot of those kind of mistakes. And Mark had a very formal structure. It sounds like from your team in terms of training. I didn't have that at the start. We built that in our business once we had the business for the next wave of traders that we have. We had something similar, but when I started, I didn't have that. I had a guy teach me synthetics every possible way and every banking problem that could exist in options with how to compute interest and all that stuff exactly correctly. And I'm like, wow, what the hell am I going to do with that? So I didn't learn any fancy risk management tools other than run for the hills or something. I don't know. But boy, you learn fast. That's for sure. That's for sure.
Only one way to learn in these markets. It's fast.
Yeah, is do it. Do you know what I tell people when they tell me I'm paper trading? You know what I tell them?
What?
What do you think? Mark, Jason, go ahead. Tell me what I tell them.
Say
It's
you
not
never
real
learned.
unless you have money on the line.
Yeah.
Exactly. I say, listen, good for keystroke recognition. You will not learn a thing unless you jump in that swimming pool with no floaties on and try to swim to the other side. Okay. Until you do that, you are not going to be good at this. So get rid of that freaking paper account, your floaties, and get in there and get wet. Feel what real emotions like with real money.
It's a rough one. It's a rough ocean, but if you can't handle it, you got to get out,
No, I know. All right. The worst trades we've ever made. All right, guys. Good to see you as always. Another weekend upon us practically. Like I said, Thursdays are synthetic Fridays in my mind. And I love them. Going downtown for a big dinner tonight. So excited. Anyhow, you guys have a great weekend. Anything else you guys want to say? Like
Happy trading.
happy trading. And always trade smarter, not harder. You guys have a good one. I'll see you next time.
Cheers.
Cheers.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.